Hi all, today I am going to explain about the technical analysis. And technical analysis is the examination of past price movements to forecast future price movements. And technical analysis is the study of historical stock and prices and stock market behavior to identify recurring patterns in the data. And technical analysis use variety of charts and calculation to spot trends in the market and individual stocks and to try to predict what will happen the next. Technical analysis do not consider any of the qualitative data about a company, such as the management team or the company. And technical analysis is based on two fundamental assumptions. First one is all historical price and volume patterns exhibit by the stock represent the total market perception of what is known or knowable about the individual stocks. And second one is the market does not move in a random manner, and this is the basically a technical analysis. And the next one is assumptions of technical analysis. And the first one is price discounts everything. And technical analysis analyst believes that the current price fully reflects all information, because all information is already reflected in the price, and it represents the fair value and should form the basis for analysis, and hence only a study of the price movements is enough. This is price discounts everything is an essential assumptions. And the next one is price moves in trend. And the technical analysis assumes the price creates a trend, and price moves in trends, and those trends tends to remain for the relatively long period of time. And the primary task of then technical analysis is to identify the trends in the early stages. This is known as price moves in trend, and it is also an basic assumptions of technical analysis. And the next one is history tends to repeat. Here the future repeats the past. The technical analysis is the process of analyzing historical process in an effort to determine the profitable future prices. And here technicians believes that the market essentially reflect investors psychology, and that is the behavior of investors to repeat itself. And this is also an main assumptions of technical analysis. The next one is advantages of technical analysis. And first one is focus on price. Here the technical analysis focus on price movements, and the price movements usually precede fundamental development by focusing on price action. And technicians can automatically focusing on the future to keep pace with the market, and it is better to look directly at the price movements. And the next advantage is trend prediction. The main advantages of the technical analysis is to it helps in investors and traders to predict the trends in the market. And next one is entry and exit recommendations. Here the technical analysis can help within the timing of a proper entry point, and timing plays an important role in trading and investing. And the next one is provide valuable information. The technical analysis provide a valuable information, and the price charts is easy to read historical accounts of a security price movements over a period of time. And the next one is provide early signals. The technical analysis give early signals and also exhibits the psychology of traders and investors. These are the main advantages of technical analysis. And the next is limitation of technical analysis. And the first one is lack of accuracy. And the technical analysis is used to forecast stocks. All of the technical indicators give possible entry and exit points. However, we cannot expect percentage forecasting accuracy in technical analysis. And the next one is bias of analyst. Just with a fundamental analysis, technical analysis is a subjective, and analyst personal bias can be reflected in the analysis. And the next one is based on past price. Here all technical indicators are based on price, which always reflect what has already happened in the market. And the next one is many interpretations. In addition to analyst bias, technical analysis is open to different interpretations. even though there are standards. And the next one is ignore fundamentals. The technical analysis does not make into account the underlying fundamentals of a company, which for longer time frames, and maybe a risk needs and to be maybe the risk needs to be considered. And the next one is lateness. The technical analysts have been criticized for being too late. By the time the trend is identified, a substantial portion of the move are already taken place. After such large move, and the reward of risk rate is not much equal. And the next one is mixed signals. And on some occasions you cannot get a you can get a mixed signals, and two different indicators will give contradictory information. And maintaining one indicator can be can buy signals, and another will reward to sell the signal. And these are the main limitation or disadvantages of technical analysis. The next is the type of charts that is used in technical analysis. And the first one is a line chart. A line chart is the simplest type of stock chart, and this is a most basic type of chart, and is created by joining a series closing price together. And line charts can be used for any time frame. And the next one is bar chart. And bar chart are used in charting and study of chart patterns in technical analysis. And each bar is a symbol created by connecting a series of price points. And typically it is used to illustrate movements in the price of stocks for a time period. The next one is a candlestick chart. And candlestick chart is another important type of chart used for technical analysis. And candlestick chart are the oldest type of chart used for price prediction. And the candlestick chart is composed of three parts. They are upper shadow, then lower shadow, and the body. And the candlestick is consist of two basic, that is bullish candle and bearish candle. When the close is higher than open, then it is bullish candle, and the when the close is lower than the open, then it is bearish candle. The next one is point and figure chart. And the point and figure chart are one of the oldest charting techniques in existence. And it was the first method of technical analysis used to track share prices. A point and figure chart plots price movements for stocks, then bonds, commodities, or futures without taking into consideration the passage of time. Unlike bar chart and line chart, which are two-dimensional, point and figure chart are based on price only, making them one-dimensional, and they do not take account into time or volume. And the lack of time constraint gives a point or an extended time period. Then it is generally used to identify period of consideration, as well as set price objectives based on chart formations. And these are the various type of charts used for technical analysis. So that's all about my topic. Thank you.